So you see a company's stock is soaring. A new product is getting all this amazing hype. But how do you really know what's going on under the hood? How do you look past all the noise? Well, in this explainer, we're going to put on our detective hats. We're going to crack the company's code by digging into the most crucial evidence there is, its financial statements.
And that really is the central mystery we're trying to solve, right? A company might look great on the surface, but is the business itself fundamentally sound? Is it actually profitable? Can it pay its bills on time? Is it built on a solid foundation? Or is it secretly a house of cards waiting to tumble? The good news is you don't have to guess. Every publicly traded company leaves behind a trail of clues. And those clues are found in three primary case files: the balance sheet, the profit and loss statement, and the cash flow statement. If you can master these three, you can uncover the real story behind the numbers. All right, let's open our first piece of evidence. This is the balance sheet. The best way to think about this document? It's like a photograph. It's a snapshot that freezes a company's financial position at one single specific moment in time, say at the end of the business day on March 31st. Now, when you're looking at these reports, you're going to see two different versions: standalone and consolidated. Standalone just shows you one piece of the puzzle, like Toyota's operations only in Japan. But come on, a real detective wants the whole story, right? For that, we always look at the consolidated statement. That's the one that rolls up all the different companies it controls into one big, complete picture.
So what's actually in this financial snapshot? Well, it breaks down everything a company owns, we call those assets, and everything it owes. Now, what it owes is split into two buckets: what it owes to others, like banks, those are its liabilities, and what technically belongs to the owners of the company, which is the equity. It's a perfect accounting of its net worth on that one specific day. And this brings us to the one unbreakable law of the balance sheet. It's this fundamental equation: assets must always equal liabilities plus equity. Think about it for a second. It makes perfect sense. Everything the company owns had to be paid for somehow, either with borrowed money or with the owner's money. There's no other way. It has to balance. If it doesn't, you know the evidence has been tampered with. Okay, detective, let's move on to our next case file. If the balance sheet was a photo, then the profit and loss statement, or P&L for short, that's the video. It tells you the story of a company's performance over a period of time, like a whole quarter or an entire year. You'll also see the P&L called the income statement, and it's designed to answer one simple but absolutely vital question. During this period of time, did the company actually make any money? It gets to that answer by adding up all the money that came in from sales, that's revenue, and then subtracting all the costs of doing business, those are its expenses. The P&L really tells a story, from the top line all the way to the bottom. It starts with revenue, right at the top. As you move down, you subtract different kinds of expenses. Now, there's a key metric here that analysts get really excited about: EBITDA. They love it because it shows the profit from the company's core business before you factor in things like interest payments, taxes, or non-cash charges. It gives you a cleaner look at operational health. And then finally, after every single cost is accounted for, you get to the famous bottom line, the net profit. So we've seen the snapshot with the balance sheet, and we've watched the movie with the P&L. But now it's time for what is often the most revealing piece of evidence of all: the cash flow statement. This is where we literally follow the money. Because, profit is one thing, but cold, hard cash, well, that's the real lifeblood of any business. And here is the plot twist in our investigation that trips so many people up. A company can look profitable on its P&L statement, but actually be bleeding cash. How is that possible? Well, it's because of accounting rules. A company can record a sale as revenue the moment they send an invoice, even if the customer hasn't paid them a single rupee yet. So the P&L shows a paper profit, but the company's bank account might be totally empty. And man, this is the perfect cautionary tale. Just look at Kingfisher Airlines. While the P&L was showing these huge losses, the cash flow statement, it revealed an even scarier problem. Year after year, the company was just burning through hundreds, then thousands of crores in actual cash from its day-to-day business. For any financial detective, this is a 5-alarm fire. This is a massive red flag. Okay, so we've got our 3 case files. But just staring at the numbers themselves doesn't give you the full story. To find the real insights, the real truth, we need to connect the clues. This is where a good detective brings out their specialized tools. And in the world of finance, that tool is ratio analysis. Seriously, think of ratios as your magnifying glass. By comparing one number from a financial statement to another related number, you suddenly create context. I mean, a 4 billion rupee profit might sound massive, right? But is it massive compared to the company's total sales? Or compared to how much money the owners have invested? Ratios are what give us those crucial answers.
Let's look at a real-world clue from our case file on Bharti Airtel. Back in 2019, its debt-to-equity ratio was 1.52. Okay, it's a number. But the real detective work, the fun part, is figuring out what that number is trying to tell us.
So I'll ask you, what does that 1.52 actually tell us about the company? What's the story hidden inside that single data point? Well, here's what it means. It tells us that for every 1 rupee that the owners have put into the company, that's the equity, the company has gone out and borrowed 1.52 rupees from lenders. This ratio is a direct measure of financial risk. The more a company relies on debt to fund itself, the higher its leverage, and the riskier its entire financial structure becomes.
All right, you ready for the master detective technique? It's called Dupont analysis, and it's just a brilliant way to deconstruct a company's performance. We start with what is arguably the most important ratio for any owner, return on equity, or ROE. It asks a really simple question. For every rupee of my own money I've invested, how much profit is the business generating?
But here's the absolute genius of the DuPont model. It takes that one ROE number and breaks it down into its 3 core ingredients. First, how profitable its sales are. Second, how efficiently it's using its assets to make those sales. And third, how much financial leverage or debt it's using to amplify everything. Now let's see why this breakdown is just so powerful. At first glance, HighLevCo looks like the star performer, right? I mean, look at that massive return on equity. But when we use our DuPont analysis to look under the hood, we see the real story. LowLevCo is actually more profitable and more efficient. The only, and I mean only reason HighLevCo has a better ROE is because it's juicing its returns with twice as much debt, which makes it a far, far riskier investment. See how that works? So, what's the final verdict here? By using these 3 documents, the balance sheet, the P&L, and the cash flow statement, and our magnifying glass of ratio analysis, we can finally piece all the clues together. We can go from just looking at a bunch of raw, confusing data to forming a really informed judgment about a company's past performance and its current health. And it's so important to remember what we're actually looking at. As the legendary investor Warren Buffett said, he has no use for forecasts. They're just guesses about the future. Instead, he focuses intensely on the track record, the hard evidence of what a company has actually done in the past. And that evidence, that track record, is sitting right here in these financial statements. So just remember, financial statements aren't just boring pages of numbers. They're the story a company is telling about itself. The case files are officially open. Now that you know how to read the clues, what stories will you go out and uncover? Thanks for joining this explainer.